Hey guys, it's Investing with Noah, and today we're going to be talking about stock options. Stock options are a way for you to leverage your money into controlling 100 shares of a stock. First, we're going to be talking about call options. A call is the ability to buy a stock. There are different things that determine at what price you're buying a stock and what time you can buy the stock. This is generally bullish. You're paying for the right in the future to buy at a price which is hopefully lower than the market price. For example, you might try to buy Apple with a call option. If you chose to exercise the option, just to use the option, you might buy at 245 when the market price is 250, allowing you to buy at $245 a share and sell at $250 a share. This is essentially allowing you to buy low. On the other hand, you have put options, which is the ability to sell at a certain price on a certain date. This is bearish. You think the stock will be going down. You're paying for the right to sell at a price which is hopefully higher than the current market price. For example, you might pay for the right to sell at $255 a share when the market would only pay you $250 a share. So you could buy from the market at $250 and then turn right around, exercise the option, and sell it that same share for $255. This is essentially allowing you to sell high. Now we're going to go over a couple things that are important to know so you have a background for understanding stock options. There are 5 main parts of a stock option. The first is a ticker, which is the underlying security. In this example, which we're going to be using throughout the video, Apple is the ticker. The type is either a call or a put. As we've just explained, the call is the ability to buy, and a put is the ability to sell. The expiration date is important because you can only exercise the option up till that expiration date. In this option, it's 3/20 or March 20th. That means that on March 21st, this option will have no value because it cannot be exercised. This plays a role in determining the price of the option. The farther out the expiration date, generally the more expensive of the option. The reason for this is because it is more likely for the stock to get more in your favor, either up or down, by a farther out date, as opposed to a date that's maybe only a week or two from the current date. We also have the strike price. This is the price you can buy or sell at. So if I were to exercise this Apple put, that would mean that I could sell Apple for $250 a share. And then we have the value, which is $8. One thing to keep in mind is that each option controls 100 shares of a stock. This is how you get leverage, but it's also important to note that even though the option is $8, this actually means $800 because it's $8 per share. Okay, now we're going to go over buying versus selling options because similar to a stock, you can either buy or short, which is sell. Buying gives you an option, as you may have guessed from the name. It's also considered debit, and sometimes in spreads they'll be referred to as debit spreads. This means that you are paying. Selling gives you an obligation. This means that you are on the other side of the trade, and there's something called assignment. On the plus side, you're getting paid. So when you click that button, you will have money deposited in your account because someone is paying you for the option. Assignment is when someone chooses to exercise the option. Because you are the one selling the option, you may have to sell them shares or buy shares from them at the strike price. For example, in the $250 Apple put on the other side, if you were to sell that put, the best way to think about it is that a put is someone's ability to sell. So you selling the put is your obligation to buy it from them at that price. There are 2 types of selling options, covered and uncovered. Covered is when you already own 100 shares of the security. For example, Apple. If I already own 100 shares of Apple and I sell a call, there's really no, and I bought the shares for lower than the call, for the price of the call, I'm not going to lose as much money. If it's uncovered, that means that I might have to buy at a very high price and then sell it back to someone for a much lower price. So the potential for me to lose a lot is much greater. If that was confusing, just wait a second because we're going to go over what the profits are for buying and selling both calls and puts in the next few slides. For buying a call, we're going to do a sample of profit and loss. As you can see, above the strike price, there's a break even. This break even is where you will make $0. And then past that point, you will make money on the call. Your maximum loss is whatever you paid. So in this case, it's an $8 call, so we're paying $800. Therefore, our maximum loss is $800. We have a potentially infinite maximum gain. Depending on how high the stock is, the price of the stock is at our expiration, we'll make that and a certain amount of money. Let's do a sample calculation. Okay, the stock's at 270, so that is above our break-even price. For a call, the break-even is the strike plus the cost. If you can't understand why, we're going to go over that in a second. So, the stock is at $270 at expiration. That means that thanks to our call, we can exercise. So we can buy 100 shares at $250 a share. Okay, now we can sell them back at market price for $270 a share. If you're not going to have enough money in your account to do this because it gets very expensive, your broker will loan you the money on margin and then just sell it immediately back for you. Okay, so one final part to include is the cost of the option, which is $800. So now let's do our calculation. We're buying 100 shares at $250. So that's costing us $25,000. Then we're selling 100 shares at $270, which makes us $27,000. Finally, we have a cost. We already paid a premium for this option, so we have to take away our $800 cost. That leaves us with $1,200 in profit. Okay, let's go over to buying a put. Buying a put is similar, except you actually make more money as the stock goes down. In this case, you would calculate your break-even from the strike price, $250, and taking away the cost, which is $8. So that gives us a break-even of $242. If you think back to how we calculated the option in the last slide, the reason that we have a break-even like this is because if you were able to buy with a call, if you're able to buy at $250 and sell at $242, if you were able to buy at $250 and sell at $258, you would be making $800. This $800 would only barely cover your $800 cost, leaving you with a profit of $0. For a put, this makes sense for a break-even because you're having the ability to sell at $250 and you can just buy at the market price of $242. That would mean that you're buying for $242 and selling for $250, which is an $8 profit. Multiply that by 100 shares and you have an $800 profit, which is the same as the cost of the put. Therefore, you would make no money. So let's see what happens when you have a strike price that's between, or when you have a stock price at expiration that's between the strike price and the break-even. Okay, as in our example, the stock price is $245 when you choose to exercise, which can be March 20th or any time before March 20th. You're buying 100 shares at $245, which is the cost of the stock at the market. So you're putting in an order to buy 100 shares. Thanks to the put, you're selling them at $250 because the put is the ability to sell 100 shares. And the cost for this put you were paying was $800. So we're buying 100 shares for $245, which is costing us $24,500. We're then selling those 100 shares for $250, which is giving us $25,000. Finally, we're taking away our costs because we've already paid that. That gives us plus $500 on the stock trade, minus $800 for our cost, and $300 in loss. Our max loss on this trade would have been $800 because if the stock price was above our strike price, there would be no point in selling at the strike price because you could sell at the market for more. So that means that this option would not have been exercised. You would not want to exercise this option. Therefore, you would not be buying or selling anything, so that would be $0, and you would just be taking away $800, which is your cost. The reason that people would buy an option is so that they have the exposure to 100 shares of stock. They're able to make much more profit and only spend $800 and have a maximum loss. If you were to buy Apple stock and it went down, you might have to sell at a lower price. This way, if the stock goes down, you just don't have to buy it at all. Or in the case of a put, you don't have to sell it at all if it goes up. Okay, now let's go over selling options. Like I said before, selling options will give you a credit. So when you sell this option, you have a profit of $800. And your maximum profit occurs when you sell a call when the price of the stock is below your strike price. For example, if the call was $240 and the Apple was already at $250, a call is the ability to buy. So nobody would buy at that higher price, $250, which is the strike of the call, when they can buy at market for cheaper than that. Therefore, they would not exercise the call, and you wouldn't have to sell your shares to that person. So you'll be keeping that $800 in profit and not paying anything. Okay, so think back when we were buying a put, when the stock ended up being between our strike price and our break even, we lost money. This is different when you're selling a call. When you sell a call, let's say the stock is at $254. Okay, so a person would exercise because the stock is above the strike price of a call. So you'd have to sell 100 shares to that person for $250. And then you'd have to buy 100 shares from the market at $254. This would give you net 0 shares at the end. However, instead of paying $800 for the trade, you received a credit of $800 for the trade. So you make $25,000. You have to spend $25,400 to buy the shares back, which is a loss of $400. But then you made $800 on the option, which means that you made $400 in profit. So one thing to keep in mind is that although these have potentially infinite losses, which we'll get into the next slide, that you don't have to get the direction of the stock right. It can move up or down from your strike price as long as it doesn't move too much, and you will still make money. When you go back to buying a put, you can see that when the stock doesn't, if the stock moves against you at all, you're going to end up losing money if it doesn't go in your favor. So you have to keep, and it has to go in your favor a decent amount before you make money. That's why many people choose to sell a call. This gives you the opportunity to make money even if it doesn't go quite where you expected it to go. Okay, let's go on the flip side, selling a put. One thing to keep in mind is that while general puts are bearish, selling a put would be bullish. And while buying a call is bullish, selling a call is bearish. Essentially, it's the opposite. Okay, so for this one, let's think of another example. This one I'm going to be showing you what happens if the put goes way against you if you're selling it. All right, so in our example, Apple stock tanked. It went up from wherever it was when you bought the stock to $225. Thinking back to what a put is, you'll remember that it's the ability to sell 100 shares at the strike price. So when you're on the other side, you're having the obligation to buy 100 shares at that same strike price. If the stock goes down to $255, you still have to buy the shares from the person you sold the contract to for $250 a share. Then you can sell them at market for $225 a share. In this trade, you have a credit of $800. $800 means it would be profit for you. So you're spending $25,000 to buy the shares, and then you're selling them back for $22,500 to the market. This leaves you with a loss of $2,500 on the stock. Then you make $800 from the credit. This means that your total loss is $1,700. The more Apple goes against you, the more you're gonna have in the loss. Now, these are both this would be, for example, in an uncovered put. In an uncovered call or put, you have generally larger losses. In a call, you can have it be covered by owning the stock. This means no matter what you're selling at, you already own the stock. You don't have to buy it at the higher price. For a put, you have to have what's called a cash secured put. This means you have enough money to buy the shares, and therefore you don't have to sell immediately at whatever the market price is. Often, people would sell a cash-covered put in order to own the stock at a low price. Let's say I really want to own Apple, but I think what it's trading at right now, let's say $250, is too expensive. I could sell a $225 put, knowing that if Apple goes down to $225, I'm going to have to, or below, I'm going to have to buy it for $225. On the other hand, if Apple goes up, I just keep my money in profit. Thanks for watching. In the next video, we're going to be talking about different types of spreads and what happens if you can't afford to exercise the call. What are your other options? Thanks for watching.